In this episode of Ask the Expert, the independent investor sits down with Nori Poblador, managing partner at Navegar. Navegar is the Philippine-based private equity firm he co-founded in 2012 that has provided growth capital for established companies like the Bistro Group, Great Deals E-commerce, Bose Coffee, and TaskUs. Across their two funds, Nori's team manages over $300 million in total assets. So today, Nori will be sharing insights pulled from his years working across investment banking and private equity for institutions like Credit Suisse, Morgan Stanley, and Rothschild. We'll be exploring the story of how Navegar got started, Nori's personal investment philosophy, what he looks for in an ideal investee candidate, and what early stage founders can do today to best ready themselves for growth partners like Navegar in the future. So Nori, great to see you again. Thank you so much for joining me this morning.
Thanks, Thiago. Thanks for having me, Thiago.
So Nori, perhaps a good place to start here would be with the Navegar story, right? So no doubt the audience knows a lot about the businesses that you've championed over the last decade now, the ones I mentioned earlier. But let's jump back to 2012 for a second. Maybe we can talk about why you decided to establish Navegar in the first place. So what problem were you trying to solve back then?
Actually, the story goes back to 2000. And the story begins in Singapore. So I founded Navegar with Javi Infante, who I went to high school and college with. And I moved to Singapore in 1999. And within 3 days, Javi moved into the same apartment block. At that time, I was at Morgan Stanley doing private equity investing, and he was at BCG. Doing the consulting thing. But at some stage, he wanted to come back home to start a business, and that business was ambergris. And obviously, when you start a business, one of the things you need is capital. And because Morgan Stanley was providing capital, we talked about it a little bit. Unfortunately, at that time, he was in very early stages of ambergris, and the amount of capital he required was a little below the minimum of Morgan Stanley's ticket size. But that was really the beginning of Navegar, because throughout the years, I was trying to look for investments to make on behalf of Morgan Stanley in the Philippines. But at that point, this was 99, 2000, 2001, 2002, the companies couldn't really absorb the amount of capital that Morgan Stanley wanted to deploy. But in the 12 years from that time until we started Navegar, I think the Philippines went through a tremendous period of growth. Went from negative growth to 4% growth to 6% growth to 7% growth, and the company sort of grew into a size that then became interesting for private equity. Also throughout that period, Javi also started another business. He started Endron, which required a little more capital at that time. But I had left Morgan Stanley and didn't have that capital to invest. So we actually started talking about raising a private equity fund for the Philippines in, I'd like to say maybe 2005, 2006. And really the problem we were trying to solve was providing an institutional source of capital for founders who needed to grow businesses in the Philippines. There was that white space where no one was providing capital. No institution was providing capital. I think many of the businesses that started at that time had to go to a collection of families and high net worth individuals who would then invest the money in the businesses, but it never made for an ideal shareholder composition because everyone had different views on growth, debt, dividends, and if you're a entrepreneur trying to build a business, that's the last thing you need, to also manage different points of view when the business should be only going in one direction, and that's growing, right? So that was the business we were trying to solve. And for a long time, we were talking about it. It was like, oh, let's try to do it. Oh, but you know, the issue was we didn't think we were going to be able to raise at least $60 million, which we felt was the proper size for us to run a business, which meant having to cover overhead costs, right? So we felt that the fund had to be sizable enough to support the business. And it wasn't until 2010, December 2010, when we met some folks from Sweden who had a year before that, helped raise a fund for Bangladesh. They managed to raise $100 million for a Bangladesh fund. They met us because Javi and I had been talking about it for so long, right? And we had mentioned it to several people. And we had happened to mention it to someone from Goldman Sachs. And the partner I was talking about, the eventual partner that I was talking about, Brummer and Partners, had hired someone for Goldman Sachs. And when he was hired, basically he said, hey, I don't want to just run a Bangladesh fund. We need to be doing more in Asia. So Patrick Brummer, the chairman, basically said, okay, where should we go, right? And they had identified the Philippines. And Patrick was like, okay, I like it. It's, the returns are uncorrelated to the rest of the world. There was growth. There was no competition from private equity perspective. Then he said, okay, I need to find a team because they're not going to manage a private equity fund from outside. They need someone on the ground. And because we had mentioned it to someone, an ex-colleague of that guy, he said, well, I know someone. Let's talk to them. And it happened so fast. We met them December 2010. We were invited to visit Sweden by April 2011. I think we started raising the fund in September 2011, and by 2012 we were established and off to the races, I guess.
Nori, it's so funny that you say everything happens so fast, because I suppose that really is how things shake out, right? When all the pieces are in place, things do tend to shake out quickly. But you're talking since 2000. You were working with Javi Infante on this, so that's about 12 years in the making. So 12 years of slow pitching this idea back and forth with potential partners, and then 2 years of just rapid movement there.
But you're right. Things have to be in place, right? And I think we were raising money at the perfect time, because prior to that, the country had sort of stabilized. We weren't yet investment grade, but we were heading to investment grade. The country was accelerating its growth rate from an average of maybe 4.5% per year to above 5% per year. The GDP per capita was approaching $3,600, which is really the point where consumption patterns start to change. So it made, I think Noynoy had just been elected. There was a promise of cleaning up the government. And I think that resonated with investors, because historically the issue had always been, oh, can we really do business in the Philippines? It's kind of murky there. There were still beliefs that it was a very corrupt environment. So everything sort of fell into place. The stock market was going gangbusters. So it was an easy story to sell at that time. And I think if we had tried at any time before that, it would have been difficult to get to the amount of capital we raised at that time.
So that's the story of Navegar from 2000 to 2012, and what an amazing happenstance that your high school friend moved into that same block as you in Singapore. But now let's look at let's say 2012 onwards, right? So since you started supporting Philippine companies in their growth journeys with the establishment of Navegar, how has the local business landscape evolved? especially in light of the rise of rapid scale tech startups?
Yeah, I think it's almost night and day, right? And I'll go and compare it again to the time that I was investing in 2000, and I had mentioned that many of the companies that needed capital couldn't absorb the amount of capital that we were trying to deploy. Um, by 2012, it had gotten to a point where there was a larger number of companies that could absorb $15 million and above, which we were trying to deploy. By the way, that was the same amount we were trying to deploy in 2000. The difference now, we're now in 2022. The difference now is the startups. I mean, we're talking about early stage companies. I think that's the focus of this discussion, right? The startups are now raising amounts in that quantum and even greater quantums than that, right? When we started the fund, it was really meant to be a growth fund that provided capital to growing businesses that had some sort of track record that had been around for a while. But we're investing in the Philippine market, which is not as a developed market as other parts of Asia. So I think we've had to be flexible. And although we're primarily a growth capital fund, we've also had to make investments in later stage companies and buying out shareholders instead of just adding fresh capital. But we've also played the other side, investing in earlier stage companies. And yeah, it's amazing to see how vibrant that segment has become, the startups, and the amounts of capital that they're trying to raise now. It would have been unimaginable in 2000 and even in 2012.
So maybe as a quick follow-up then, right now, after given the 10 years you've been investing in these companies in the Philippines, how would you describe your personal investment philosophy? Right, what do you focus on in a business? Is it its model, its team, the opportunity that it's tackling?
Yeah, I think our DNA is more PE than it is VC. So I think we tend to invest in business models that are easy to understand and easy to map out. Because once you have that, it's really just getting the right strategy in place. I guess making sure you execute and you have a good operational team. So Navegar is a fund that all in all has 15 people, right? And that includes support staff and operations and back office and the investment team. So we can't run companies. We don't want to be involved in the day-to-day management of companies. So the primary thing we look for, obviously, is the capability of the management team or the founders that are running the business. So it's got to have a business plan we can understand, where we know which levers to pull, but it's also got to have people running it that we can support.
And if you had to, let's say, choose a single most important factor that shapes your decision to invest in a company, what would that be?
It's probably the founders and the management team, because there's nothing that can be done without them, right? And you count on them for many things. It's not just their expertise; it's also their commitment. It's also their energy. It's also their willingness to listen. Because ultimately, private equity provides capital, but we'd like to be able to provide more than capital. I think that the team we put together includes individuals with experience in different aspects that could be important to companies, right? There's strategy, operations, capital markets experience. So I think, if you have an entrepreneur that's hungry, wants to grow his business, knows how to do that, but is also open to working with us to help them get to the next level, I think that's a good combination. And as I said, right, we're not going to get involved day to day, but I think we do things as basic as trying to get their finance processes and systems in place so that they don't blow up when the growth stage does come, when they're climbing that steep path of revenue growth. We try to put that all in place for them so they can focus on just growing business and selling.
So you're describing this relationship now between investor and investee. Maybe we can concretize that a little bit more. So how do you define the role that you play as an investor in these companies' journeys?
Yeah, I'll steal an example that one of my good friends that's been doing private equity for a long time uses to describe what private equity's role is. Right? It's almost like we're a physical trainer that comes in at some point to help the companies and the management teams get better. And the wish really is that at the end of the period that you're invested, you leave them better off than when you joined them. So private equity is medium-term capital. It's not long-term capital. But during the amount of time that we're together, we share a goal of increasing value for all stakeholders. And we do that, by being counsel, by filling gaps where they might be needed. One of the things we do is we second individuals to investee companies, and we've done that in many areas, but most of the time it's appointing CFOs to basically take over and establish, I guess, listed company level processes and reporting procedures, right? The entrepreneurs have actually welcomed that and said, "Oh, you want to help in finance? Please take it away from my hands, right? I'd rather just grow the business and sell to clients." So that's worked pretty well. But it's not done by us at the Navegar office on a day-to-day basis. We'll find someone who can be at the company, seconded by us to help them, and they do day-to-day.
I think that metaphor of a personal trainer is a fantastic one. It's you do regular check-ins, sure, you train the mindset, sure, but ultimately it's still the entrepreneur that needs to put in the work, right, and do the exercises and do the training, right, and follow the regimen you establish. I think I'd love to hear some stories from your experience running Navegar. So since you began Navegar 10 years ago now, congratulations. Has your approach to investing evolved based on your experiences? Like, have there been any pivotal successes or maybe better yet, blunders, right, over the years that have shaped your posture as an investor today?
Yeah, I think every single opportunity that comes across your desk, every single due diligence that you do, every single investment that you make, every exit that you make always teaches you a little bit of something, right? And it keeps adding to the knowledge base. So yeah, we've had successes and we've had blunders, as you call it. But I think the one thing first that's different when we first started was we thought we could be laser focused and just focus on, for example, growth capital, minority positions. But I think what we do now is we look at the broader set of opportunities. As I said earlier, we figured that sometimes just adding growth capital won't get the deal done. I think there's always the element of founders having committed to the business, having committed all of their resources to the business for such a long time, that a monetization for some of their years of effort and sacrifice is welcome. So many of our investments have actually been a combination of primary and secondary capital. So that's one. We said, okay, we've got to be flexible, right? It can't just be growth capital, although the preference is still growth capital. And then the other thing is also we are willing to do both control and non-control investments. And the other thing is stage, right? When we, in Fund 1, our first 3 investments, I think the average age of the companies was maybe 12 years. But I think if you take our whole portfolio now, with our later investments, that average has probably gone down to slightly below 10 years. Because there's some early stage companies that we invested in, which we didn't think we would be doing in the beginning. But there are certain opportunities where, yes, they might be early stage, but within a year or two, they would be defined as companies with a substantial amount of revenue. But even in those cases, we won't invest in startups where the business model is not yet determined, and the company might have to pivot to find that business model that works. So yeah, that's.
So Nori, you
I don't know if that answered your question.
Absolutely, but you pointed to 2 things that I'd love to kind of expound on a bit. So first is that need for flexibility, right? And then the second is this trend, this trend towards earlier stage, right? Or at least, well, not too early stage, but earlier than what you initially had planned to invest in. With those 2 points, were there specific investments or specific deals that you explored that shaped those 2 trends?
Yeah, I think maybe I'll point to 2, one from the first fund and one from the second fund. The first one with an early stage company, the first investment with an early stage company was really in a company called TaskUs. And when we met them, they had been in operations maybe for 3 or 4 years. They had 1,200 employees. The entrepreneurs were 28 years old. They had pivoted their original business into what TaskUs was at that time, and they were EBITDA positive. So that was a big help. But they were only, they were a young company, and of course, when they present their business plan, they had hoped to quadruple or even quintuple in the next couple of years. And it's tough to make that call. But TaskUs was in the BPO sector, and Javi grew up in the BPO sector. He had started one of the first BPO companies in the Philippines. Our finance director was actually his CFO at TELUS when TELUS had acquired Ambergris. And we have one more guy working for us who was also in the BPO sector. So that's a sector we really like and we really know. And in that sense, we were comfortable because we thought, hey, there's a clear growth path here. We know what levers to pull, notwithstanding that they're a young company. The entrepreneurs were more than willing to learn from us, right? Because they were 2 American 28-year-olds based in Santa Monica that knew nothing about the Philippine setting in terms of accounting and taxes and how to set up, the intellectual property office issues. So we helped them stabilize their business. And it was amazing what those guys did from 1,200 people when we first met them. They had grown to 12,000 people by the time we exited. in 3 years. And they had grown by, I mean, they had grown by 10 times, which was, I think, actually they exceeded the growth plan, right? So obviously with that success, it gave us a little more comfort that, hey, you know what, we can do early stage companies. I think the other example, and it's still playing itself out now, is the investment we made in Great Deals. And Great Deals is an e-commerce enabler, and if you think about it, that's really an old world business model, right? Instead of a distribution model, where you have, geographical territories as your areas of responsibility. Great Deals is using that business model, but they have exclusive rights online. So it's not a geographical definition; it's online. And we had also always felt that the Philippines was lagging behind even its Southeast Asian neighbors in terms of e-commerce penetration. And we felt that with a lot of investment going into the internet infrastructure, into payments, into logistics, we felt that it would catch up the penetration rates at some point. So when we were looking at Great Deals, I think the e-commerce penetration was maybe 1.8%. Thailand was, above 5%. China was in the teens. So we felt, okay, there's a growth path here and a business model that's easy to understand. We felt it was just a matter of time. The time frame of that when we made the investment was February 2020, just before the lockdowns because of COVID, right? So what we were expecting to happen in 2 or 3 years basically happened in a few months. So yeah, it's, I think there's a lot of comfort now that, yeah, doing early stage companies is not as scary as it appears. The difference between what Navegar does and the VC guys, what they do is, I think the portfolio construction is a little different, right? The VCs will make many bets in many companies, and the formula is basically, if we make 20 bets and maybe 4 of them fail, the 16 that make 4, 5, 6, 7, 8 times your money will more than make up for those failures. The private equity model, especially for us, is we'll maybe make 5 or 6 investments from one fund, and we can't afford to have one of those go really bad, because it's a deep hole to climb out of if that happens, right?
From your experience, have there been any missteps that you've encountered as a PE firm?
Yeah, I think we've gone down many paths of trying to invest in a company, and going deep into diligence, even though there may have been warning flags already at certain stages of the process. We ended up not making those investments, but due diligence costs a lot of money, and if you go down that path, then you're basically paying the cost of the same as making a full investment. So I think that's one of the skills you develop as the business matures, right? Hopefully you're able to say sooner, hey, you know what, let's abandon ship. This isn't going well. But yeah, I think we made more than a couple of those.
So in doing that due diligence, what are some red flags then that you come across that signal that a company may not be actually ready for an investment?
It's quite tricky, because many of these companies, they're growing so fast, and it's natural that, and this is true for 5-year-old companies, as it is for 12-year-old companies. I think when businesses focus on building the business, growing the revenues, the pipes always get left behind, right? So there's always some difficulty in understanding how profitable the business really is. Sometimes even determining how much revenue there really is. So I think that's one of the challenges that we face, and that we have to deal with all the time. But it's not malicious on their part that they don't have it, but that's just a fact of life. But I think we know enough now to say, oh, okay, this one, it's just they've grown too fast and they don't really know. Versus, oh, this one, yeah, they've grown so fast, they don't really know, and they'll never know. Or even worse, right? They don't want to know, or they're hiding something. Yeah, so I think, we've met, what is it now, maybe 400 entrepreneurs and reviewed 400 opportunities, some deeper than others. So yeah, it happens that sometimes they don't really want to show the full extent of the profitability or non-profitability of the business.
Right, and then just to illustrate it, maybe what does that funnel look like? So you've looked at 400 opportunities at this point. How does that get whittled down to the X number of deals you've actually made?
Okay, so out of 400, we've made, and I'm counting the latest one we made. We made 6 investments out of Fund 1 and 4 investments out of Fund 2, so 10 investments. And we have a deck that shows how that funnel looks from, meeting the entrepreneur to signing an NDA, to submitting an LOI, to doing full due diligence. But yeah, I mean, when you cut through it all, it's 10 out of 400. Yeah, no, it's tough, Tiago. I mean, think about it, right? If you have 100 million to invest and you have you make 6 investments, basically you're talking about, because you have fees to pay out of that 100 million, right? So let's say you subtract $15 million in fees, you basically only have 85 to invest, and 85 divided by 5 is, what is that, 16 million per company. If you lose 16 million in, I mean, let's say you write off one company, man, that's a whole, you basically have to double one investment just to make that up, and you'd have 0% return on that, right? So then you're left with the 3 other companies that have to double or triple for you to make your IRR hurdle and make any meaningful return for your investors. So it's tough. It's unlike VC, right? The multiples on money are typically 4 or 5x instead of 2 or 3x, right. And there's a little more room there to play.
And I guess the tickets are also slightly smaller.
The tickets are also smaller,
so it's easier to kind of just hedge those bets.
Although it's amazing now. I don't know. Tonic Bank was supposed to have raised
131 million, I think.
Yeah, 131 million. I don't know how much Kumu raised from General Atlantic.
Incredible.
I mean,
it's a different landscape, I imagine, from when you started.
Yeah, I mean, even great deals, right? What have they raised? They've raised close to $40 million now, and they're going for more. I think they'll start raising again towards the end of the year. So can you imagine Morgan Stanley in 2000, right? $15 million we were trying to invest. I mean, it's a testament to how far the Philippines has come and how quickly the companies have grown, right? Which I think is good for the economy. You're creating more entrepreneurs, creating more wealth. Actually, that's what I like about this job.
So maybe going back to the evolving business landscape we touched on earlier, Our early stage ecosystem has seen a number of companies joining the Series A and Series B club, right? More so than in the years prior. Great Deals actually is a great example of that, and one that shows that your team at Navegar has already entered this space in a
Yeah.
sense. So maybe you can walk me through how those types of partnerships come about. Maybe how do you evaluate whether a company is mature enough to really benefit from a group like yours coming in with a Series B investment?
Actually, for Great Deals, we were the first institutional investor. So I don't know if that's probably considered Series A.
Mm.
But that one was the team is constantly looking around for opportunities, and we've identified themes for the fund. So business services is one theme, and domestic consumption is another theme. We've sort of we've further broken down those two themes into sectors. So each associate is in charge of two or three sectors, and that's all they do every day. Um, they're doing research. They're looking at SEC documents to size the businesses. Um, we we communicate a lot with advisors. We use our network to get the word around that we're looking for interesting opportunities to invest in. In Great Deal's case, I think one of our associates knew someone from their advisor, and they had brought the opportunity to us. We said, "Oh, first pass, right? 2-year-old company." Um, at that time, revenues were below a billion pesos. GMV was below a billion pesos, and we said too small. Um, but then we said, "Oh, wait, this is in e-commerce. Our whole thesis that e-commerce penetration would increase. Let's take a look and see how steep that growth curve is." Um, so we engaged. The advisor sent us all of the projections. We spent a lot of time talking to the entrepreneur, testing him on what needed to get done, constantly checking. Okay, this fund, because due diligence takes a while, right? And that gives you the benefit of really seeing whether they're tracking the plan or they're behind budget, if they had inflated their numbers. Um, so yeah, throughout the process, it was check, check. He's keeping up to date with what he said he would be doing. Um, so yeah, that became, we probably had, this was pre-COVID, so it was easy to do. We built a relationship with the founder over 4 or 5 months, and that was lots of contact hours, whether it be over a meal just to figure out his personal values and his commitment to the business, or sessions with him and the management team, seeing how they were trying to assess how they would execute. Yeah, so every day you get closer to being comfortable that they will achieve what they say they will achieve. Then you sort of put that in an investment committee memo, take it to investment committee. Um, Obviously, you hire legal advisors to check everything's above board, financial advisors to check the books, tax advisors to check potential tax liabilities. We also do a lot of ESG. We're committed to environmental, social, and governance standards. So we do an ESG audit as well. And then if that all checks out, then we take it to committee, and if it's approved, then we make the investment. So I think with Great Deals, it probably took 6 or 7 months before we ended up closing and committing money.
So Steve, the founder of Great Deals, he's quite the influential voice now in the startup community. A lot of earlier stage startups and even peers of Great Deals really do look up to this firm. So Navegar coming in as the first institutional investor, Series A, I'm sure that investment deal kind of put Navegar into the investor outreach radars of a lot of these smaller firms. I'm curious, does Navegar plan, or do you plan on exploring investments in even earlier stage startups in the future?
I think it was TaskUs that put us in the deal flow for earlier stage companies, because we've been seeing a lot of VC type investments. Even I would say maybe it started accelerating in 2018. I think we wouldn't be doing our jobs if we don't learn about companies that are raising capital. We will continue to meet with them. I think we'll remain true to our, I guess, PE DNA. Our investment style is still, as I mentioned, right? It's 5 or 6 investments per fund. Therefore, the business should have a business model that we understand and that's predictable. It's exciting to look at the startups, and interesting to follow them through their journey, right? So we'll continue to meet with the startups, and if it's not appropriate yet for us to invest at that stage, hopefully at some later stage, it'll become something that fits our investment philosophy and investment style. And fully recognize at that stage, it's probably de-risked, it's probably grown a little bit, we'll probably have to pay a little more in terms of the value of the business, but that's how it goes.
So given that philosophy, given that posture, are there any specific sectors that you've been actively exploring recently? Like, are there any spaces that you find personally very interesting or exciting?
Yeah, I think if you expand the 2 themes that I talked about, business services and consumption, that really almost covers everything, right? So if you look at consumption, that can also include infrastructure that supports the growth of consumption. We made an investment in a company called Royale Cold Storage that basically wanted to expand capacity for their clients and grow with their clients. So for us, theoretically, or that doesn't fall into the consumer sector, but because it supports the consumer sector, then that's something that that we were willing to invest in. So I think anything that supports either of those themes is interesting to us.
Maybe as a parting question, what advice can you give startups in the seed and pre-Series A stages to best ready themselves for growth partners like Navegar in the future?
Well, I think they need to be, I guess, in the seed stage, they should, as much as possible, partner with investors that can add some value, and it might be opening doors to other investors. It might be giving you access to a distribution chain, because I think the more used you are to having outsiders help you, it's sort of like a muscle, right? That gets trained. Again, the training metaphor. So the more you're willing to listen to others, you get used to it, and then by the time an institution comes in, hopefully, you're not scared of accepting advice or listening or having someone else have a view on how the business should go. And I think also when you're a startup, you should get at least the basics right. Try not to put off. Can't imagine, Thiago, sometimes businesses that have been around for 20 years, the stock and transfer book is not in order, right? Anyway, if at some point you want to go to the capital markets or attract an institutional investor, when they come in, they're going to say, okay, what's the cap table like? Who are the other shareholders? What shares are we buying if we're buying shares? And if you don't have all of that in place and have to scramble to reconcile 20 years worth of movements in the shares, you're like, wait a minute, what happened when and who owns this? And I sold it to you. Yeah, so I mean, just the basic things to be put in place, right, to make it easier for an investor to come in. Maybe get a good corporate secretary, I guess.
You know, in the last session of Ask the Expert, I was speaking with attorney Reggie Jacinto Barrientos from PJS Law. The advice she gave startup founders was, even prior to incorporating, as early as possible in your journey, have someone on the team who is dedicated to compliance, dedicated to keeping things in order, keeping all the records in place. So I guess same advice, right? Do it as early as possible. Otherwise, maybe their deck lands on your desk. It's interesting. Everything works out until you do your due diligence, and then
I mean, the later you start, the harder it gets to clean it up, right? You've got to catch up on a lot of things. And the same goes for accounting also. It's like start early, hire a professional. Absolutely. Pay a little bit for it if you have to.
Right, exactly. And I do love circling back to that metaphor of a trainer, right? And looking at investors not just as sources of capital, but also as collaborators early on, so that once it comes to the stage where you might come in, whether it be another Series A investment or a Series B, right? That partnership can be fruitful, as opposed to transactional, right?
Yeah.
So Nori, thanks so much. I think it's a fantastic place to end our chat. Nori Poblador, thank you so much for making the time and sharing your insights with me, with the Independent Investor. A real pleasure, and I hope we can have you back in the near future.
Thank you, Thiago. Likewise, it was a pleasure to